Today on Great Chat, we're talking about looksmaxxing and growthmaxxing. We promise it'll make sense. I'm Ashley, and this week I'm joined by Helen and Angela. Great Chat is brought to you by Mercury, radically different banking loved by over 300,000 entrepreneurs. We use Mercury to run this podcast and love recommending it to other founders and fund managers. It's free to get started. Try it for yourself. Visit mercury.com to learn more and apply online in minutes. Hey guys.
Hey guys.
Happy Lunar New Year and the year of the fire horse to everyone.
I'm all for it. I never pay attention to these things, but I've done some reading on the year of the fire horse and extrapolated what it might mean for my life, thanks to ChatGPT's help, and I'm ready. Let's go.
I think my favorite post that I've seen is Ivanka Trump saying like "Happy Year of the Horse," and it's just like 4 photos of her looking off in the distance,
and her
white.
face looks totally different.
But like not even not red or like a colorful color, which is generally what you wear to celebrate Lunar New Year. But I loved the inclusion, but it made me laugh a little bit.
I just laughed because the first comment I saw was, "We know you're the president's granddaughter, but just because," and I was like, wait, she's his daughter. But that was perfect. I don't know why. Thanks, Ivanka.
I mean, I also really flexed my AI skills. I used ChatGPT to make an AI-generated photo of our family dressed in festive colors, so I didn't have to go through the hassle of changing my kids.
I didn't even know that was AI generated.
Yeah, right?
Impressive. Very impressive.
Yeah, I went through a few iterations, but then our faces got more and more distorted the more I tried to change the outfits. Right. So then I had to go back. But it's been a great news cycle, and I don't know if you guys saw the video of the Unitree robots performing at the spring gala, but that was pretty awesome as well.
I feel like we had very different reactions to that. I immediately went to, this is terrifying, and why, with small children in the house, would be terrified to have one of these as like somebody who's, as Max said, emptying my dishwasher and like taking out the trash. It's like, sure, but then where do they sleep at night?
In the closet, locked.
Right. Well, we talked about this before, but Angela, you're very stoked on these.
I mean, I am, other than the fact that I do have this non-logical fear that if I had one in my house, I'd wake up at night and, they would just be standing over me watching.
It seems totally logical. It seems completely logical.
Not to get really dark, but like one of these things killing like a pet or a child would be such a bigger thing than like the Tesla crash, right? Like it's just so much more visceral. And so let's hope that's not possible. But I'm on the fence. I don't like doing the dishes. So maybe I'll get one of those like, less humanoid versions.
The soft, this is what I said, like the form factor could be like a soft, more Grimace from McDonald's shaped robot. I would be down for that versus these guys who were like doing full choreography and like have a black belt in every, type of martial arts. So yeah, I'm all for having more help around the house, but it was a little scary for me. Although, wait, Angela, you wanted them to be, what was the Backstreet Boys comment?
Yes, I'm just manifesting Unitree, founders of Unitree, whoever of Unitree that listens to this podcast, please have your robots perform the Backstreet Boys, Everybody Dance as part of their show at the Sphere, because right now it's just a video with lasers of robots dancing, but it could be a whole stage full of Unitree robots, and that would be a very viral moment. So that I'm manifesting that into the universe.
I feel like recently this whole looksmaxxing thing has like sort of jumped into more mainstream discourse for better or worse. And I know it's been around for a while and I think we catch fringe pieces of it. But like now I feel like you have to be extremely online and get every reference to get some of these like VC jokes on Twitter.
Helen, what is it that you sent? I need to find it. Like I understood 0 words out of the phrase.
It was clever and funny. In fact, I typed into Claude like how I might open this podcast in a looksmaxxing bro voice. And it said, "What's up? Quick looksmaxxing update before we get into it. Soft max this morning, moisturizer, good lighting, strong podcast fundamentals. We are ascending. This is great chat." So basically it's like you talk like that and it's like mogging frame-mogging is like a thing. Like if a guy has like a bigger frame than another guy, then he's like frame-mogging the smaller guy. But you can like substitute frame for anything. Am I getting that right?
Incel speak, right? Like
it originated in like incel culture, but then like I think they're saying that something with like the Zoomer generation, during COVID was just extremely online and got very narcissistic and, created this whole subculture of looksmaxxing, which is basically like going to extreme lengths to, become a Chad, which is like a, good looking bro or something. And
it's funny because I had seen this language start to crop up over the past couple weeks, but like it somehow got into my feed of like normally like nerdy tech stuff, but it was like about this guy named Clavicular, who I guess is a streamer. And it was just, I think people were sharing it because like the language was so absurd. But then it was over this past week that it jumped into like tech Twitter discourse. And the moment that brought these worlds together seems to have been the Dwarkesh and Dario podcast interview, because there is this one frame of the podcast where like Dwarkesh is like total Chad mode. He looks like so ripped. He's got like the great profile. Like he looks like a Chad. And then Dario's kind of like hunched over and like looks a little nerdy. And so, someone commented, oh my goodness, like Dwarkesh totally frame-mogged Dario. And then it feels like ever since, like it has infiltrated VC Twitter in a way that is like terrifying. And I'm hoping it's like a short trend, but it was very funny to see that over here, that lingo, like in a very like more like sort of subculture space, and then make the leap into now every tech headline, has like, someone's like putting it through the clod. Like
political candidates are using it in their campaigns now too. So I think the fastest way to kill something is for like millennial women to be talking about it, or like Donald Trump to be using it.
We are doing our part, damn it. This is where looksmaxxing dies.
Yeah, exactly.
We'll have to come up with a title for this podcast that is our one and only nod to this particular trend.
Pod maxing, gesture maxing, pod.
I still don't really know what looksmaxxing is. And I was also like, today's year old when I discovered that there are like OnlyFans creators that have completely like AI-ified, effects themselves so that the videos they're streaming are not of themselves.
Yeah, I don't know if you have, any looksmaxxing is involved with AI-ified. But like, here's the thing, Angela, you just asked, what is looksmaxxing? Honestly, it's like South Korean plastic surgery that's been going on for like decades. I think there's like this really insane thing that's like bone smashing, where they take like a hammer and they like hit their cheekbones to make the bone grow back like more intense or something. And I was like, well, yeah, I think women have been like breaking their jaws to have like, and then shaving down the jawbone and doing insane stuff like this for such a long time. And now it's like getting a lot of attention because men are doing it. So I don't really know what will come of this, but I think that a lot of it, to me at least, feels just like, oh, there are tiers of men and there are all these extreme lengths that men are going through to frankly impress each other.
It feels
this sounds familiar. Like
feels like the convergence of a bunch of trends. Like during the pandemic, everyone was suddenly on Zoom all the time, and so people became really appearance obsessed. I remember being at Glossier, and like the pandemic was like a boon for beauty sales. You would have thought it would have been the opposite. And then there's like the incel culture, and there was, I forget which magazine did it, but there was like a big magazine cover that got a ton of attention a couple of years ago that was all about like the intersection of incel culture and plastic surgery, and people going for these like very chiseled very specific like sort of ideal male look. And now I can understand how this has like seeped into the sort of tech bro world, because one theme I keep seeing in my feed is like, well, now that like AI is better at thinking, the only thing to do is to get really hot. And of course, that also intersects with GLP-1s and peptides. A lot of people are saying this. And so it just kind of feels like, yep, like looksmaxxing is like at the center of all of these slightly disturbing trends.
Guys, Margot Robbie and the Wuthering Heights press tour. I don't know if this is over your feed, but this is consumed 100% of my social media feed. And she looks...
Okay, well, what about it is significant to you?
She
looks incredible.
Amazing.
The outfits. The outfits. Yeah.
The like showmance with Jacob, the story, you know, like everything. Just no notes. Like 10 out of 10.
Do you think that it's now a requirement for like male and female, actors during the press tour to like spark rumors of there being like, on-set attraction and all, because I feel like that went around too, right? So like what specifically caught your eye on the press tour other than the outfits, or was it just the outfits?
It was looksmaxxing to the extreme. I think she looked, it just the whole, it was like very on theme. The outfits were on theme. The dynamic between her and her co-star, mirrored the storyline of the movies. And it was just this whole, the production value. And it made me think, it's sort of like movies are so commoditized now. The way you drum up interest is to create this whole ecosystem. And I wonder if we're not seeing similar echoes of that in tech with the personalities and product launches and then the way narratives are built that extend beyond just what that... I bet so many more people like me have seen the press tour and have been engaged in that than will actually go see the movie.
Oh my God. Can I try to make the like most absurd parallel of all time?
100%,
That's literally what this is for. That's what this podcast is for.
So, like, Jack Altman announced he's joining Benchmark today, and it was like beautifully teed up. The press tour moment was that he had the entire Benchmark partnership on his podcast. Like, what was it, like a month ago or 2 months ago? And actually, Alex Conrad from Upstarts joked, like, is this the first ever, like, video job interview or whatever? So anyways, they, like, were drumming up some excitement for that moment. And there's, like, a little more theater around it.
Well, I mean, maybe that's the requirement now. Because if every announcement is, like, some big billion-dollar number on Twitter and a thread and tagging a bunch of people and there's like kind of, you have to kind of break through. And maybe now it's like the sort of theatrics around like the pre-release and then the story. Yeah. And I love it. I love a big production. So this is, this is entertaining. And we were wondering what was going to sort of, replace the valuations and the, sort of like really, the like sort of cookie cutter announcements that we saw from 2025 that made everything start to look the same. So if, I'd love to see a fund announcement or a Series B round with like a Margot Robbie style press tour with outfit changes of this caliber for sure. So yeah, I saw the Bloomberg article from Natasha that released performance data, I guess, on benchmark funds. And I think I saw some comments that were like, who is counting benchmark out? And I was trying to think about it, and it's like, were people counting them out? Was it just that they weren't like going the mega fund route? And it really felt like it was just like the Founders Fund boys doing the like anti-Bill Gurley tweets as usual. I don't know if anybody was actually counting them out.
I think there was some skepticism. I think there was a lot of pushback after they did, was it Manus in China? So there was like the geopolitical debate that definitely certain Founders Fund partners leapt into headfirst. But also like Miles Grimshaw went to Thrive last year. There's been some like, they've made some strong hires recently, but I think there was some like, oh, no one leaves. Oh, and Sarah Tavel like stepped back. And so like no one leaves Benchmark until you're ready to retire. And so I do think there was actually some uncertainty, but the performance data was amazing. They're like up at 10x from their 2020 fund, which a lot of people's 2020 funds might not be so good. So that's like particularly impressive. And then
exactly
like 3x already from 2024. So yeah, I actually love this as a narrative violation to like, oh, you're either a tiny, tiny craft fund or you're a mega fund and there's no in between, because Benchmark is sort of living proof that is not the case.
And also, I feel like in the go direct, every VC having a podcast or, like a really noisy Twitter account, like I feel like those guys have just kind of done their own thing, and
yeah,
that's
but
great.
they just
More of that.
hired
That'd be
Jack
great.
Altman. That's like
Yes,
so...
who said he would be continuing the podcast? Maybe that's
yeah.
like, it's a media acquisition.
There's no way that's not also like a brand and media play. I mean, I'm sure Jack is
for sure
also a fantastic investor, but but it's very authentic. It doesn't feel like VC firm marketing, right? Which I think doesn't hit as well as something that it's like the cult of Jack's personality and his guests versus a benchmark initiative. Well, that feels like actually a perfect segue into the thing we wanted to talk about, because it does feel like all of the headlines these days are about these like massive, massive growth rounds and, like numbers that we've never seen before. And obviously, Helen, you and I play at like the very, very other end of the spectrum, like mostly pre-seed. Angela, I know you do a lot of different things, but you've at least like touched this world much more than we have, given that you're a partner at SoftBank's Vision Fund. And so maybe just to summarize, like what has changed, like it's really a story of concentration. The top 30 VC firms captured 75% of all fundraising in 2024, and it's even more aggressive in 2025. The 10 largest VC funds collected 43% of fundraising dollars. I mean, we're seeing this at the firm level. When Andreessen Horowitz announced their new like $15 billion across funds, they bragged that it was 18% of all venture dollars allocated in 2025. Thrive announced a $10 billion fund 10 this week, which is insane because their first fund was like $5 million and it wasn't that long ago. And then like this is directly connected to what we're seeing on the company side. So, a small number of companies like OpenAI, Scale AI, Anthropic, Project Prometheus, XAI, they all raised over $5 billion in 2025. And those companies alone accounted for like 20% of all venture capital spending in 2025. And I think given the headlines we've already seen this year around Anthropic's massive raise, a $30 billion Series G, there's like the rumored $100 billion plus OpenAI fundraise that's in progress. Like the numbers for this year will be even more extreme. And so we thought maybe it'd be fun to like dig in a little bit on how this part of the universe works and like what are some of the trends and things that we're seeing. And so maybe like just to start, because I have a hunch that like the way Anthropic's $30 billion round got done is very different than what my like pre-seed process looks like. And so like Angela, like how does something like that even come to be?
The interesting thing about these rounds is that it's not like a surprise. It's not like you win a prize for suggesting that you invest in Anthropic at some valuation. In some ways, it's not even about investing. It's just more about capital allocation. I feel like growth stage investors are now equity salespeople. They have this huge ticket that they need to go sell to different investors across the world. And it works both ways. There's a lot of inbound demand as well. And as we've talked about in the pod before, SPVs galore, like single layer, double layer, triple layer. I don't even know what these words mean at a certain point, but just the amount of people that are making funds, their entire businesses just on allocation. So it definitely feels like a shift from investing to allocating. And that's just, I think, indicative of how consensus driven a lot of the big deals are. I still remember when Thrive led the $100 billion round in OpenAI, and then SoftBank came in, there were all these headlines like SoftBank's coming in at $100 billion. The market has, reached its peak, which was ironic because we didn't price the round, but just because we were involved, the consensus was that it must have been overvalued. And then in the span of a few short months, it also became consensus that, investing in OpenAI at $300 billion was a no-brainer and everyone was fighting for allocation. So everything is very consensus driven, everything is very momentum driven, and there's not a lot of variation. Like, I don't think there are any growth announcements where you look at that and you're like, like, what is this company? I've never heard of this company before, or what does this company do? And that's probably just indicative of the funding needs of these companies. Like if you have $40 billion to invest in Anthropic, that gives Anthropic visibility to invest and compute for some period of time versus spreading that 40 billion across 10 different companies. Then like, what is a company to do with 4 billion? That's not enough to get you to where you need to be. So the market feels very rational from that perspective, in the way that it organizes itself.
What are some of like the downstream effects for like it being concentrated at such few companies? Like, would most of these funds be, leading growth rounds in like a larger set of companies sort of at that stage? And are those companies now, like what's the fate of those? Like what are the sort of downstream effects of this?
One of the questions I'd love to get people's perspectives on, and maybe you guys have interacting with these firms, is just how the value proposition of an investment has changed. It feels like for a lot of firms, you're not just investing in a company for the financial return, it's for some strategic angle. So if you're a multi-stage firm, the early stage firm is not necessarily about generating outsized returns. It's about getting access to the pipeline for your growth stage investments. And if you're investing in the growth stage, it's not just about putting money into Anthropic. It's maybe you're a hedge fund and you have powered land somewhere and you want Anthropic to use your powered land, and becoming an investor in the cap table is, so everything feels like it ladders. Or what Thrive is doing with its holding company, it feels like investments are not just investments. There's some laddering up. It's almost like investing in the growth stage is like a Trojan horse of sort for the larger strategic objective of the fund, whether that's Thrive or General Catalyst or Andreessen or any of these really concentrated growth funds. That's how it feels, at least to me. I'm curious what you guys think.
I mean, I think my question really came from like being an early stage investor and like, when you set your tiny startup out, right? Like, and they decided to get on the venture train that is the ABCD, et cetera, around. It's like you want to know that there's capital waiting for them when they reach those phases. And I think this question of concentration just around, top 10 or whatever companies that are mostly in AI, just sort of like, I think that it changes the trajectory, and it also changes the mindset of startups, founders and investors who are investing at early stage. So, I think like maybe the data hasn't shown us yet exactly, the answer to my question, which is like, what happens to all these companies that have more recently raised like a C or D round? Like, maybe they go public faster, or maybe, they have to figure out some sort of survival. Maybe it'll bring back the small cap IPO, which we've talked about.
That would be great.
Before. I know. So that's where my curiosity, if anybody has like a thought there, I'd love to hear it.
I feel like we're still working through COVID. Like, I don't think all of the morass that was created during COVID has been worked through. I think everyone thought 2023 was going to be the year, and then 24, and then 25, and now we're in 26, and there haven't been as many shutdowns or M&As or IPOs. And so there's still just this big bolus of companies that are just existing that's tying up people's time and headcount. So I'm interested to see when that gets worked through on top of all the new companies that are being created.
I also wonder how much of this is a reflection of the state of the public markets, where it feels like you have to be a massive IPO to be able to go out. Like Box's IPO, we were doing 150 million in revenue when we went public. Like, that just doesn't even feel feasible today. Helen, Dropbox was bigger, but like not astronomically bigger. And so, either you're SpaceX or Anthropic and you're big enough to sort of like completely make the market, or I guess any other exit is going to be ideally something that tucks into one of these companies. Kind of feels like it's the vibe in the venture world today.
I think it's just a function of how the public markets have evolved. And, one of the big differentiators between whether companies list on the NASDAQ or the New York Stock Exchange is sort of how quickly either of those exchanges can get them included in the ETFs, because that's where all the flow is. And I think if you're a small cap, micro cap, that's just it's not going to happen. And so there's some natural bias to that. But I did learn 2 new phrases from public market investors today about all the volatility that's happening in the AI sector trade. And that's FOBO, which is, a version of FOMO, but it's fear of being obsolete. So it's basically like any industry that is at risk from the AI trade. So that was software and SaaS, which you guys talked about last week. That was insurance recently, because OpenAI announced some integration with an insurance company, and now it's moved on to real estate and REIT, because people are worried that there's going to be no more desk workers. Everyone's just going to be replaced by agents, and therefore you don't need, commercial real estate anymore. So fear of being obsolete. And then HALO, which is hard assets, low obsolescence. So like after 2 decades of money pouring into software. Now all the money's going to hardware. And someone was saying, if you just look at the $650 billion that the hyperscalers are plowing into CapEx, that dwarfs any amount of spending they have on software. And so, Helen, to your point, there's probably just going to be some catch up that the industry does from investing in very capital light software businesses to shifting into more hard assets to capture that spend that's flooding into the marketplace. Although most of it's going into chips and NVIDIA. I think something like 80% of the cost of a data center is just the chips.
And then 20% to the dancing robots.
Yes.
That will haunt Helen's dreams. Maybe like another question coming from like the early stage investor perspective, where like, the mythology around early stage investing is like, you have to be contrarian but right and see things before other people see them. And I think some of these like growth stage investments can look kind of obvious. And I don't mean that in an offensive way, but it's like, oh yeah, like Anthropic and OpenAI are like both seem like they're going to be winners of this AI platform shift. And so what is harder than it looks about growth stage investing? Is it the access? Is it winning allocation? Is it like figuring out the price? Although so many investors are coming into this round, like who's even setting that? Like what's the hard part?
I think there's probably a bifurcation between like the mega rounds and then the rest of growth investing. And for the mega rounds, it's probably a question of allocation. Although, as we talked about, the size of these rounds are so big. It's more, if you're investing enough to get the allocation. If you're willing to invest, 50 to 75 million, you're probably getting allocation. It's just harder if you are trying to invest $1 million into, a 50 billion round. So I would say that is really more just about getting allocation. I would say the true growth investors would probably say they were the ones that saw the potential in Anthropic when it was a $4 billion company and had no revenue versus when it was a $400 billion company. And so just what it means to be a growth investor has become so skewed given the trajectory of these companies. I think Anthropic has said that they're at a 14 billion run rate, and it's taken them 5 years from when the company was founded to reach that level of growth. I think it took Google, which I think heretofore has been like the best business model in the world, something like 8 or 9 years before they reached that, although probably much more profitably than Anthropic. And I think it took Meta something like 12 years. And so previously you had the arbitrage of where the inflection in growth has happened. And I think in the AI world, there isn't any like smiley face or J curve. It's just like exponential. And that's what's made the trade so obvious. But maybe a corollary to that, something I've been reflecting on, I don't know your thoughts, is just for investing in general. I used to think that picking the right, company, assessing the right metrics, doing the right analysis was what set you apart. Like if you figured it out, like that was what it was. But in my mature age, and I don't know if it's growth investing or investing in general, I've realized that that's really just table stakes. And the hard part is actually influencing the founder to your point of view or to achieve what you want to do. And we can debate whether that's good or bad, but that's been something that's on my mind, which is like, what is hard to do? It's influence. And I think the leaders of all of these mega funds have incredible influence. Like I saw Sam Altman post a tweet congratulating Josh Kushner on, Thrive's fundraise. And there's a ton of investors on OpenAI's cap table, but he's not posting that, compliment for every fund. And so Josh's relationship with him, his influence, that's a real differentiator versus saying like he did a good job picking OpenAI.
That's so interesting. I feel like we've been so obsessed with access, right? Like that to me, that's been sort of the theme of like early stage investing, and are you catching a hot founder when they're leaving their last company, and then when we talk about SPVs, it was another thing around like access, where people are willing to sometimes pay the double, triple layer of fees just to say that they have Anthropic or OpenAI in their portfolio. And I think the influence part is so much more interesting and sometimes invisible. Right? Like, and often not touted so publicly the way that example that we just used. So I wonder what more of that might look like. I am concerned that it is concentrating, not only across a certain number of companies, but also, across a certain number of influential people that are able to do this influencing. I don't know how you democratize influence. I don't know how you sort of spread the wealth of influence the same way that access, I think, could reasonably get democratized.
One other interesting thing to talk about that does feel new to me is the competitive dynamics where actually I think Josh Kushner is a little bit of a poster boy for being like monogamous with OpenAI, whereas a lot of investors, including Sequoia, including Founders Fund, have invested in OpenAI, Anthropic, xAI, like companies that are very much in competition with each other, which I find fascinating. I find fascinating philosophically. I find it fascinating from like a very tactical, like information rights perspective. Like, I'm sure those founders have had to like lock down information flows, knowing that their investors are on their biggest competitors' cap tables as well. There must be like some very strategic sharing of information. Again, to use a totally like an example that does not compare at all to this, but like, Helen, there were no investors who were investors in both Box and Dropbox when we were there. Like that would have been unthinkable. Like I remember when employees went from Box to Dropbox, I was like, they're dead to me. Like, how?
I don't think it's
that?
everybody who thinks. I saw this funny tweet from Ethan Choi, who is like tweeting like crazy now. He's at Khosla, and he was like, I'm a one woman. He's like, I like Josh Kushner. He's a one woman, one LLM kind of guy like me. And I thought that was pretty funny. And I think that there are still a lot of investors who, still stand by that, not, investing in competitors. And, as an early stage investor, the small fund, like I share a lot of deals with emerging managers, and I think emerging managers do a great job of saying, no, I have this in my portfolio, like I can't take the meeting, so I don't think that.
But the funny thing is, on the earlier side, it's much more likely to just happen because companies are going to pivot 1,000 times.
Oh, so exactly. Like, that early, yes.
But when you've been like an OpenAI investor since early on, and then you decide to go into like a growth stage Anthropic, that feels like a statement. And yes, I think this is actually like a point of tension across the venture ecosystem.
I also wonder, I know nothing about how Sequoia or these other funds operate, but I wonder how much of that is driven just by the way that decisions are made. I think Thrive is, maybe this is just public perception, but more founder driven by Josh. SoftBank certainly is founder led with Masa. And I wonder at other firms if different partners have different relationships with different founders. Like what if one partner at Sequoia had a relationship with Elon and had invested in SpaceX and needed to invest in xAI and another, I'm curious how fund dynamics influence some of these decisions and ultimately probably check size as well. Like, if you're going all in on one, you're probably less likely, but if you're, spreading the love, you're probably just investing a much smaller amount in each of these companies. And it's more of a relationship management tool.
Also, if you have like billions of dollars you need to put to work, there are only so many companies that are big enough to absorb large amounts of capital. And so I do think some of this is like AI FOMO. You don't want to miss this platform shift. And, like it looked like OpenAI was like so clearly the early leader. And lately, like Anthropic has really accelerated and it feels like there's a real race. And so I'm sure there's just a desire like to not miss. But then at the same time, like a lot of this is downstream of how these fund sizes have gotten so big and how many, we saw like there were multiple $5 billion plus rounds last year. Like there are only so many companies that can absorb that much capital. And there are firms that like have raised such huge amounts of capital and they need to put it to work. So I wonder how much that plays in as well. They're not going to make like thousands of early stage investments to run through that money.
As I think about growth investing and the arbitrage it's going after, it feels like really the lever that growth investors have to pull is time horizon, and that the argument for companies staying private longer and taking growth capital versus going public is they can make decisions over a longer time horizon. And the example I think of is Uber. When it went to IPO, it needed to get rid of $1 billion of OpEx. And so they spun off their autonomous driving unit. And that was celebrated at the time of the IPO, like great financial decision. But now 5 years later, it's become an existential threat to the company. And who's to say whether ATG would have gotten them there and if it was the right asset. But, the company probably would have made a different decision had it stayed private as a quote unquote growth company for longer. And even Acorns, who, Helen, you're a resident fintech expert. So you may have a view on I don't have a view on the company, but during COVID, they were going to go public and then they pulled their IPO and they said, we're going to stay private because we can get better valuations in the private market, which for any like finance 101, like, you know, the idea that a liquid private asset is worth more than a liquid public one is sort of the antithesis, but it really comes back down to time arbitrage. And so it's interesting to me that in this cycle, so many secondaries funds have popped up, and ultimately, unless the different base of LPs that are investing in the secondaries versus the original funds themselves, I feel like they're going to run into a lot of the same issues that the private equity industry ran into when they were just selling companies to one another, which is just generating profits for the firm, but not actually for the end LP. So that's like the one thing that's like an interesting evolution of the growth market is the explosion in secondaries. And I'm curious how that ultimately all plays out, because the time arbitrage comes at a direct conflict with, you know, path to liquidity and distributions.
That's super interesting. I was just thinking, like, you know, Ashley and I go to a bunch of emerging manager conferences or like GPLP events. And so when we meet other fellow emerging managers, I'd say over the last 2 years, there's just been an explosion of emerging managers who are raising secondary funds. And it seems like smart and obvious, but when I hear their pitch and what their criteria is for investing, it is often that there is a path to an exit within the next 3 years. And so how much control they have of that, or how like their ability to like really predict or underwrite that is really questionable, especially like you're suggesting, you know, we could just be passing the potato back and forth, like, and creating liquidity for like these funds. But in the end, it's just not really going back to the original investors, which is a requirement, I think, for us to maybe stop this direction, or just, you know, sort of not stop the direction, but like stop the concentration and what we're seeing in the market right now.
I mean, we've talked about it on the pod before, but ultimately the path that all these asset classes go after is they diversify and they become asset managers. So private equity diversified and became asset managers. And I think we're seeing the very concentrated funds in venture capital do the same. I think Thrive, General Catalyst, A16Z, they all do much more than just venture investing, growth investing. And that's, to me, just a function of the maturity of the market and where things always trend to. So to me, like, growth investing is like, it's not that it's not that interesting, but I'm more interested to see where the smart investors are finding the next like niche to arbitrage and the next lever to pull.
I have this visual of just like this like traffic jam. Basically, like everything Angela is saying, I just have like a very visual thinker.
Well, I mean, it's not like this is like outside of like venture, but I saw a report from JP Morgan that looked at all the debt against like the major private equity firms that are software focused. And Thoma Bravo and Vista each have something like $36 billion of debt against their software companies. And so it's not just like equity returns, but it's like debt obligations and like what that means for the entire ecosystem when you have, you know, hundreds of billions of dollars of debt against these software companies that can't get exits.
Yeah.
To your point, there's like so much that hasn't worked through the system yet. It's almost hard to define what growth investing is, because there's like all these growth companies that need to either die or like find a way to downsize and merge.
Thank you, Angela. You're the best.
Woo!
Thank you for listening to Great Chat. Have questions for us? Make sure to submit them at anothergreatchat.com. See you next week.